Hello, everyone. My name is Cody Hall. I am the host of The Faces, Entrepreneurs Are People, and the founder and CEO of Telehelping, a virtual staffing organization, and the hero and sponsor of my podcast. So thank you, Telehelping, for allowing me to talk to great people like Christian. Christian, how are you this morning?
I'm doing well, thank you.
Wonderful. Christian, where are you calling from today?
I'm actually in Raleigh. Based myself out of Raleigh. I was a Philly guy for a long time, and then good old COVID hit, and instead of spending my time in my basement in Philly, I decided I would go to the beach in Wilmington, North Carolina.
That's fair. That's fair. You know, I spent most of my childhood growing up in Charlotte and even college. So I went to UNC Charlotte, grew up in South Charlotte. So I'm very familiar with the Raleigh-Durham triangle.
Yeah. It's been a couple of years. I'm enjoying it.
Good. Well, Christian, you alluded that you're from Philly, which makes more sense about the hat comment during our initial introduction. So, give us a little bit of understanding of who we're speaking with here today.
So I've been in the financial services business for about 32 years. I can't believe it. Actually, I've been around the business for my entire life. My father was a Merrill Lynch lifer. He was a manager of advisors, hired thousands of advisors into the business. They've been kind of around my life from the very beginning. So I really understand the advisory business. And for a long time of my 32 years, I was just kind of the traditional investment management focused advisor to individuals, some pension plans, and I had this sort of aha moment a couple of years ago. Really saw the changes that were coming to the financial advice space, and got together with a couple of really great people. My team is fantastic, all smarter than me, PhDs, CFAs, chartered market technicians, and we all got tired of working for the man. So we decided to head out on our own and do this little entrepreneurial thing, and it's been quite a journey.
I think that's the greatest thing. At some point, an entrepreneur does have that one moment where they're like, "Oh, I can't do this anymore." Yeah. And so, when you were making that decision, talk about that leap that I'm sure you took as a finance guy. You're calculating the numbers, understanding the risk. What was that execution like for you?
So there was really it was a slow evolution to this aha moment. So it wasn't exactly an aha moment. I guess when it all came together, it was aha. But I was more of a traditional RIA. I had set out on my own in 2005, doing exactly what every other advisor who goes on the independent channel does, talking to clients, trying to get clients, managing their portfolios, just doing the traditional stuff. And one thing I noticed is that we were having tremendous success in our performance, but we were constantly being asked, can you lower your fees? Can you lower your fees? So we're running, 400 basis points over for a very long period of time in most of our portfolios in large cap growth, large cap value, small cap, even international. And we're doing this great job, and people keep saying, you got to cut your prices. So I saw this real change coming. Active managers have done a really great job of displacing themselves for index. And I think there's a great place for index. We use them. But it was just one of those like slow moving glacial type things that you don't realize until it's like the glacier's on top of you, that the entire industry was changing. And I was fortunate in 2012 to be asked by a private equity firm that was kind of building on an aggregation model. They were, bringing in groups of advisors under a single roof, trying to rationalize the costs of the business. Mm-hmm. And they asked me and another partner of mine to develop an investment strategy, an investment platform for them. And I started thinking about what we were doing and how we were doing it. And I started realizing that there is a much better way for advisors and for their clients, for the advisors to engage with their investment solutions. And that's where Varying really came out of.
Nice. And so when you were making that decision, so you identified the opportunity. You know, anyone out there who owns a business, there's a need to be met, right? Something needs to be happened. People are willing to pay for it. How was that transition for you, going from a stable relationship in a job, man with a family, house, mortgage, right?
All that.
And then, like, you know what I'm going to do? I'm going to pay myself. And so how was that decision? And what were that fear, that conversation like with, I'm sure, the family and taking that leap?
Yeah, there's a couple of paths that converged for me and for the industry. In the early 2000s, there started, for a long, long time, if you were going to be a financial advisor, you went to work for Merrill Lynch or Morgan Stanley, or most of them have been consolidated now, but like, you know, the Paine Webbers of the world. I'm really dating myself now. The Paine Webbers of the world, and the traditional wirehouse structure. You'd go and you'd basically get paid 40 to 50% of your production. You'd kind of create vanilla investment products. Maybe you'd do some financial planning. But advisors were getting really tired of that corporate structure and were taking the leap and going independent. And there's a lot of benefits to doing that. One, you don't split the bank. You get to keep what you killed for the most part. There's expenses that you now have to take on. So advisors were moving into this independent channel. And one of the downsides of that is that you no longer have this extremely expensive investment capability at the end of a phone. So a Merrill Lynch advisor can call up Merrill Lynch Research. I need an asset allocation. I need to know who the best large cap growth manager is. I need all these things. And there's these really smart people that they employ, very expensive people, that say, okay, well, here's your allocation based on the risk that you've told us. Here's how you populate those. Run them through our very expensive, pre-chosen, very limited choices managers. And then you're kind of going to get a good result, but maybe not the best result. So the entrepreneurial folks decided that they were going to go out on their own. And when they did that, they lost that lifeline to the investment strategy and all the research. And we were doing a lot of the research. And so the idea for us was to partner with the planning focused advisors, the guys and gals who didn't necessarily think that their time was best used building an asset allocation model, or they didn't feel like they had the expertise, or doing the manager due diligence and finding, in this now unlimited world of all the managers everywhere available to you, how do you find the best one that fits within the construct of what you're trying to create for your client? And so I got the idea that I could be, with my partners, that lifeline. And so two paths there. And one is just, strictly send models out, hope, wish them the best, or actually manage the assets for them. So become, in a way, it's called an outsourced CIO solution. But what we wanted to do is not just be, hey, here's the stuff, good luck. Because most advisors don't have the time or the resources to staff up and have somebody internally do that without spending a small fortune. Very expensive to run an investment strategy internally. So I'd say probably between $500,000 and $1 million for a medium-sized firm. That's a big hit. And another thing happens is that one of two things usually happens is, one, that CIO or whoever you've hired is really good and they want a lot more money, or they want equity, or they're not so good. And then you want to get rid of them. So it becomes almost a transitory position. Every 3 to 4 years, you're bringing in a new CIO. You have to go talk to your clients about, well, Tom's not here anymore. Here's Bill. But Tom was great. We loved him, but why is he gone? What are you going to say? Well, he wanted too much money. He was too good, so I fired him. It's a tough conversation. He wasn't great, so we let him go, and we think the new guy is going to be better. We solve that problem with how we connect with advisors in really a unique way. Unique as far as I know, in that we're providing the operational aspect of it at a very high level, institutional level investment management. And then we allow the advisors that we work with to own and build equity in us, which is something that advisors haven't done. And essentially, it sounds crazy, but if they own a small portion of our firm, 5% say, let's keep the numbers easy, they will essentially double the value of their firm. So what are the benefits? They get better investment management with all the bells and whistles, PhDs, CFAs, all the technology. They can build the portfolios however they want. They can have active management. We only use SMAs, no mutual funds. It's all tax managed. We can build custom indexes, all this stuff that advisors could do for themselves, but at a great cost. And then
you're providing that as a service to the advisors?
We're providing that as a service to the advisors. The client ends up paying us. We become a substitution for the mutual fund or whatever third party the advisors were using. Now, we still use third parties. We just go and negotiate lower prices, and then we do the trading, the rebalancing, and the reporting for the advisor. So it's called outsourced CIO, but what we call it is insourced CIO, because there's really two things we do. We do become a full-time replacement if that's what the advisors want. We're complementary. We're not trying to take anybody's job, but we can be that replacement. And then we're creating tremendous value that they were giving away to unaffiliated third parties who don't know their clients, don't know their tax situation, don't know their risk tolerances. And in fact, they're just managing a small sleeve. So how can they coordinate that with the other parts of the allocation? They can't. So that's what we do. We take the top-down approach in managing the entire portfolio for the exclusive benefit of the client. And we take all that money that advisors were spending, give them back all the time that they were spending on that, and then we double the value of their firm. So it's a win-win-win.
No, and I think that is a very unique approach to take to jumping out on your own, because you're right. A lot of folks who come from larger firms, they're losing out on that wealth of knowledge and expertise that is just picking up the phone. I wish I had someone I could call right now. I mean, I day trade. I have active spreads on the indexes right now, 0 DTE tomorrow, next week, right? And I wish I had someone to call and be like, hey, what is the ideal allocation and risk for me? No, I have to do that in my head. I have to ask myself, how much am I willing to lose for how much am I willing to gain? And we're talking 1 day, we're talking 1 week, 1 month, 1 year. And so I operate in that one little bubble where I have to have all the answers. And what you're saying is you provide that bolt-on relationship that independent financial advisors normally would have at the Merrill Lynch's to their independent practices.
Yeah. And there's actually another one step further in that there's an information vacuum where I have the advantage. You don't have the same systems as I do. You probably don't know how to value a company within 2 or 3 minutes with the systems and the programs that we've built here. We don't day trade. We tend to be investors rather than traders. But we do have an active covered call strategy that does a couple things. One, it makes the portfolio work harder. 2, the cash that we generate pays our fee plus some. In fact, we have a fee structure that actually says we'll pay ourselves based on the covered call strategy, whatever cash is generated from that. So it's a zero risk for the client, and they're getting a better portfolio that's making their money work harder. So, as the CFA guy's been around the business for a long time, I had to learn these things. And a lot of times, learning in this business means losing money. And those are the best lessons. They're the toughest ones, but they're the best lessons because you remember them. And not that we don't lose money or make bad trades, because everybody does. I wouldn't be talking to you. I'd be on my yacht somewhere.
You'd be on your island?
Yeah, somewhere. But there's an information really advantage that we have in not just the people that we have are, again, very intelligent, PhD level folks who've been doing this for a long time. But we do have all the systems that allow us to get an information advantage. And then we know how to use that information and put it into a useful format. Say, oh, NVIDIA probably wasn't worth $140. We've been talking a lot about the risk of the market and how expensive it is. A lot of folks are just FOMO. So, hey, I don't want to miss that. NVIDIA is going to go to 250, and I'm going to be in it. I know it's expensive, but then you get these weird sort of, not really a black swan event, but you get these events like yesterday where, the small firm spends $6 million to replicate what a lot of these firms have spent billions of dollars on. Kind of an aha moment when you realize that money grinds up, but it falls really fast. Yesterday was a great reminder of that.
Yeah.
Nvidia knocked out $600 billion of market cap in one day.
Yeah. I mean, we woke up on Monday, 137 points. I do futures, so I was hedged for this. And so when I thought naturally that it was going to drop last week, and this, woke up Monday morning and, oh, look, 137 points down. And that's where I was like, what is the world's ending? No, sometimes it has to take a couple steps back before it can step forward.
Yeah. Yeah. And look, there's a lot of uncertainty in the world that I think is being underpriced or mispriced in the market. We're investors, not timers. So
that's good.
You do have to look at the risk reward every day. It's got to be reassessed on a continual basis. If you're an advisor whose primary job is to service your clients and do financial planning and make sure that their holistic financial picture is being taken care of, is your time best spent sitting here looking at NVIDIA and worried about how I should allocate my capital between technology and industrials or utilities? And look, for a long time, perfect example, utilities were the safe bet. Now utilities are so tied into data centers that the utilities were down 22%, 25% yesterday. Because people are starting to question, do we need to spend $1 trillion on AI technology if this little firm spent $6 million in 2 months really replicating exactly what these billion-dollar plants are generating? So right. There's a lot to the investment process that in the last bull market of the 15 years has allowed advisors to become relatively complacent. Indexing, used to be a great way to diversify. Now, 37% of the S&P index is in 10 names. Is that diversification? Do clients realize that? And these are not just 10 different names in different sectors. These are 10 names in basically the same. They're in 3 sectors. The 10th is Warren Buffett, which is a diversified conglomerate. Like the other 9. The other 9 are, it's 35% if you count the top 9. They're the usual suspects, the Metas, the Googles, the Nvidias, the Apples. They are all tied to the same ecosystem and the same drivers. So if one goes down, likely the others will be massively affected.
And, oftentimes I explain that to people as well. They're like, oh, the market's going up. And, to be honest with you, we had, we look at the post-election rally that took place at 250 points that happened overnight. Really, if we can attribute it to 2 things, Bitcoin and Tesla. And we're talking about 2 very large pieces of the market. But what people don't understand is you can prop up a roof with 2 pieces of wood. The question is how long is that roof going to stay up there before it comes down and meets the foundation, which is where everyone else was left. Everyone's like, well, is Apple going to get, are the triple Qs going to get into the rally with them? And, where's NVIDIA during this rally? And that's why it came nice. Was it less than a week and a half later, right back down to where it started? And that's what we have to keep in mind is, I love my wife for all that she is, right? But my wife's interpretation of what's going on in the stock market is very much tied to what's going on social media. And she's like, the market's going up today. Sure, it's going up today, but is it going to stay up there? Last time Jerome Powell spoke at FOMC, which is tomorrow, the market went down immediately 100 points, and he just said, good morning. Said, hello, and then it just nosedived. And people don't understand is that's why there are experts into this. And you hit the nail on the head earlier. For people to get generally a piece of the information that you have, we had to spend and lose a lot of money. I represent a very nice chunk of carryovers that I had from my early days of trading, which are gone now. But however, they were expensive.
Yeah. And just to get in the game, like a Bloomberg these days costs $30,000 a year. Most people don't have a Bloomberg, nor do they really know how to use it. in a way that's useful, that would justify that $30,000.
Correct.
So I mean, the toys in this business are really expensive. Not as expensive as the people, but the toys can get really expensive.
Yeah, I that's a great way to put it. I mean, I'm a very in terms of my portfolio, I'm a very easy person. I work off supply and demand, which doesn't always work, but it works 80% of the time. I have about an 80% win rate, which is nice and healthy. However, when I do lose, it's not that it was something that I didn't see. It's something I undervalued. And we always try to hedge things, but sometimes, and I've been in the positions where hedges don't work, and there are smart money out there. Right? I would represent, even as an intelligent, dumb money person, I'm still dumb money, which means that I don't have all the bells and whistles that people who would work with you would otherwise have. I don't have someone I could pick up and call, Christian.
Yeah. Look, the Reddit message boards and stuff like that. Social media has an impact on investing, on trading, I should say, that we didn't have 10 years ago, 15 years ago. It was just in its infancy. And now, Roaring Kitty can take a company that doesn't have really any.
You said Roaring Kitty, and if everyone doesn't know who Roaring Kitty is, the great part about that comment is Roaring Kitty is the guy who led the GameStop rally. A man with $50,000 turned it into, at one point in time, about 50 million. And
apparently he has $400 million worth of GameStop stock now. How he did the 50 to 400 is, I don't know.
At 400 million, you think he owns GameStop?
He almost does at this point. But and I just, out of curiosity, if I don't understand something, I try to learn about it. And I didn't understand, what is this move? And it's really FOMO, and it's the greater fool theory that somebody that this will keep going up because it's going up, and valuation doesn't work that way. Valuation doesn't always work in the short term, and sometimes not even the medium term. There's one thing I learned in 2000 and then 2008. It's that valuation matters, and eventually, this is why market timing is so difficult. Eventually, valuation matters, and people go, all right, I'm not paying 100 times earnings even for a great company like NVIDIA.
Correct. And, I think that's what, we could reference even Elon Musk in regards to Tesla. He says that I've never told anybody to buy Tesla stock. He's like, I think it's overpriced. And it is. There's so many things that are overpriced. And that's why the great correction, right, is looming upon us. I mean, oftentimes, I look at things like fear and greed index, and, I try to take in all the information I can. I have an economist who works I have a small equities firm, very small in the game of equities, right? That me and a former entrepreneur who and I sold a company. It was like, let's put half of what we earned into this and let's trade it. And so I have an economist who spends his nights making my charts for the next day. And so I have really great charts when I wake up at 5 a.m. every day. And I'm lucky to have those charts because I know where I can do intraday leaps, weeks, months, and kind of, identify which stock, right? When are they going to do a pullback, or when they relatively will do a pullback? And looks at things like the election, like, oh, LLY is going to take off when Trump gets elected. What's my position look like in that versus solar if, say, a Democrat person's elected? And those are things that I'm lucky to have because I also employ that person through telehelping. So I kind of have a leverage with my staffing organization who represents hundreds of people. So I'm able to get someone from Mexico who, as an economist who has an applied mathematics degree, does, very complicated math faster than I can sip my coffee, right? He makes more money than he'll ever make in Mexico just doing my charts for me. And so I'm blessed.
You have an information advantage too. So the average person, day trading, or even just, hey, I'll just throw money at this and hope for the best. Hope is not a strategy. It's not as easy as the free money stock market, which my CIO, Jeff, PhD, CFA, CMT, CIPM, he's also a junior, so his business card, we have to fold in 4 to get it into anybody's wallet. So, but yeah, literally like the smartest person I've ever met. And that's another thing about my firm is I decided I want to be the dumbest guy in the firm.
Good position.
Right. I failed a little bit because my brother does some work for us and he's way dumber than me. So I'm the second dumbest guy.
I love it. I tell my my wife, and I've told this people, I assume every time I walk into the room that I'm the dumbest person. Oftentimes not the case, but if I walk into a room with the humility that everyone around me is more intelligent, I never, short anybody on their capabilities. And I'm in the position to be surprised by them. And it's good. Imagine walking in every room like I know everything that everyone in this room could tell me. You're not going to get too far.
Wall Street's kind of lousy with those folks, and it's a little bit scary. And in fact, when people ask me who our competitors are, the traditional answer would be, oh, it's another TAMP or an OCIO. It's not. It's ego and inertia. So when we talk to advisors, a lot of them have the ego that, oh, that's what our clients pay us for. I would argue that it's not. Your clients aren't paying you to get an extra 25 basis points return on the portfolio. They want to know that you've looked at everything in their financial situation and that things are stable, squared away. And the investments are certainly an important part of it, the most easily measurable. But at the end of the day, part of what we do that is, I think, equally as important, if not more so, is partnering with folks who put a premium on the planning process. So we're best designed to partner with financial planners who want to do the insurance. They want to look at how you're going to pay for your kids' college education, making sure your retirement is secure in a way that has a plan that you can manage to. So all those things, and we talk about specialization, but we also talk about partnership. So if it's a partnership of specialists in different areas, because one person cannot be everything, and anybody who thinks that they are, run, don't walk. And so that's kind of the mantra in sort of building this thing out and thinking about it. And I sort of learned dumb luck in some cases. Some were more thought out, but just knowing that I don't know everything and being able to admit it has been probably the most valuable lesson that any entrepreneur could take to heart.
And, Christian, I think that's a great perspective, and something I was able to learn very early on in my career in the military. When I was in, we spoke of, and I want to kind of touch back on this because I thought it was a very interesting analogy. I was in the special operations in the military, and we talked about the attrition rate of, the CFAs and how that's not necessarily highlighted, which is something we want to dive into. But, when I first started my selection class, it was 175 of us. 23 were there at the end of 6 months. And that was just 6 months. You spoke of earlier, and I want to dive into it because I don't think we appreciate the level of education and, thoroughness that goes into someone becoming certified. We think of, and there's some bad actors, I think, that, spam us all through LinkedIn, right? And maybe someone had a bad experience with the CFA because even the best programs will allow someone through the crack, right? And those people may be the car salesman. However, talk to us about what goes into that process and how difficult it is because, you should not trust me with your money. We run a home office, and I will never touch anyone else's money. But you touch people's money. Talk about the responsibility there.
Well, it's a tremendous responsibility, and trust me, I've had, in some of those cases in 2000. I was more of an analyst in 2000, running my own firm in 2008. Where, look, I didn't fully appreciate the risks that were happening. 99.999% of people who manage money didn't understand the risks. There were very few people that escaped from that situation making money, and I don't know really anybody who lost money. But yeah, we lost money in some different strategies. We lost a lot of money, and it gave me a different perspective on risk and risk management. But I talk to a lot of folks now, advisors. Oh yeah, we hired a CFA, as if it's like some magic bullet, and it's not. It just means that you have somebody who's, one, diligent enough and disciplined enough to sit through the process. When I did it 100 years ago, and it was actually 2001, I finished. It was a test that was offered once a year, and now it's offered twice a year, I think, maybe even 3 times. But the attrition rate hasn't changed. So the attrition rate is around between 40 and 50%, as I understand it. It hovers around there. It moves a little bit every year. But that means that every year, or if for the people that started with me in 1999 or whenever I started it, 60% of those people failed. And then the next year, the 40 that did make it, 60% of those people failed. And then the next year, 60% of those people failed. So even after level 2, you still have more than half the people, or around half the people, that are failing it. And again, it's not a magic bullet. It doesn't mean you're great at managing money. It means that you're disciplined and focused and smart enough to take in a lot of information, and then in many cases sort of puke it out in an 8-hour test. But it does show a certain, I think, quality of person, the character of person. And the code of ethics is incredibly strong. It's in fact a main point of the program. So you'll always get a bad actor. You get people like me who made a mistake. It doesn't mean you're not going to lose money. It doesn't mean that they're going to be a capable money manager, but it does tell you that they've got a certain something that they were disciplined enough to take 3 years. They always had to test the week after Memorial Day too. So for 3 years, you couldn't have fun on Memorial Day. And then it's a great honor to be a part of the organization. But it's not a magic bullet. And they say past performance isn't indicative of future results. It doesn't mean that because I've had some success in the last few years investing, we avoided losses in 2022. It doesn't mean that we're going to avoid losses if the market gets really crazy. And there's been really 3 times in my career, as I said, that I've been really confused and where valuation methodologies that I use didn't work. 2000. Sock puppet mania, right? Internet 1.0, the housing crisis that caused, basically an entire financial collapse. A lot of stuff didn't make sense. That wasn't quite as obvious, but that was awful. And then now it's like you scratch your head when you do a discounted cash flow on Nvidia or Apple or any of these things. There's 10 measurements that are pretty well known. I saw this in Market Watch, and Mark Hubert came out and said these are the 10 metrics that people follow: CAPE index, P, money deployed, equity, percentage of portfolios and equities. These are all at 99 to 100%, 98 to 100%, as high as they've been since the year 2000. That is a market literally priced for perfection. And people are here worried about, do I buy the dip? Or whatever they really should be doing is looking at their entire portfolio and saying, is my capital deployed in a way that I can withstand a market that goes down 30 or 40%? Some of these indicators are saying that would be the norm. So what are you doing to defend against that? Can you take a 40 or 50% hit? In a lot of cases, if you're really levered to these high flyers, you could lose 60%, 70%. I mean, 2008, a company like Las Vegas Sands traded at 80 cents. It went from $60 to 80 cents. It's now back at $60 and it's traded at, as high as I think 85. But, and maybe a gambling stock isn't the best thing to talk about when investing, but you get the idea. These things can go down to extreme levels that nobody thought they would reach. So you can get stretched valuations on the upside, and you can get really stretched valuations on the downside. Because in 2009, January of 2009, those same metrics that have never been higher had never been lower. But there weren't a lot of people clamoring to get into stocks in January of 2009.
Correct.
The bottom didn't hit until March 6th of 2009, and it's been literally straight up from there. Again, free money. My partner, Jeff, my CIO, will go off on how the Fed has destroyed the entire financial system on free money and bailing out every crisis, whether it be significant or minor.
Mhm.
But there's a lot of things that come into understanding what companies are worth and what markets are worth that a lot of people just don't really value and don't understand, that I think is going to be a big part of how folks do with their investments in the next 3 to 5 years.
No, Christian, I think that's a really great perspective in regards to your profession and the value that, as well as the disclaimer that it's not a silver bullet. Well, as we're getting ready to come towards the end here, I have to say, have a very unique approach to your business, the value add. And oftentimes folks listening, maybe thinking about a financial advisor, where you would be someone that many of our folks who on here and my clients would be seeking to work with. So, which is great. I love diversity, right? I love talking to the same people who are awesome because everyone's individual, but tell us, how do these folks get in contact with you, and what's the best way to communicate, and what is that client profile, so that folks listening, most of who are CFAs, how would they want to connect with you and get more information?
Well, you can go to our website. It's Varium IP. Varium, by the way, is Latin for "we are different," because I'm trying to build a different organization that comes at things a little bit differently than what has traditionally been the case. When we talk to individual investors, whether they be someone with $200,000 or some family with 200 million and up, we always direct them to our planning partners who aren't affiliated with Varium. We will manage that money for them, but only after they've gone through the process of connecting with advisors that we partner with or that we recommend. Because there's so much more to the financial picture than just the investments. So we'll recommend that they go through the entire process. We have a multifamily office that we work with. We've got some really great advisors that deal with what they call the mass affluent, less than $500,000 to invest, and then we got people that sort of span the middle. So if you give us a call or send me an email, I'm on LinkedIn, Christian Hyldahl, Hyldahl, Viking blood. I'd be happy to have a discussion about what you're trying to accomplish, and I can point you in the direction of a firm that we would recommend you do financial planning first through, and then it finally gets to us and how we manage the portfolios based on your individual risks, what you're comfortable investing in, what your style of investment is. There's a big educational process that happens, but that's how people. I'm happy to facilitate that relationship for folks. So we don't take primary clients in that. We don't take the single investor, but we've got really great partners that do a lot of the things that we don't do well. Again, specialization. We specialize and focus on the investment management. We let that other important stuff, the insurance planning, the retirement planning, the education planning, all that stuff be done by the planners that we work with.
Wonderful, Christian, and great insight. And of course, everyone, if you are listening and have an issue getting connection, of course, you can rewind and listen to exactly what Christian just said, but say you couldn't and you didn't. You can also email us at info@telehelping.com, and my team will connect you with Christian as well. Christian, fascinating conversation and perspective. If truth be told, I didn't know you existed, right? Your particular place in this world. And so it's very rare that I get to meet someone like you and have the conversation. So from me to you, I truly appreciate you taking your valuable time and in meeting with me today.
Absolutely, man. It's always great to kind of tell the story. We are a little bit different.
Of course,
it's right in the name, but we are trying to create a situation where we let the advisor be better. We let the client have the absolute best experience that they possibly can. Doesn't guarantee outcomes, but it certainly does increase the odds that you do get a better outcome than otherwise. And that's what really drives me. And so I hear you're up at 5 a.m. I'm glad you sleep in. The rest of us are out a little bit earlier than that, taking care of business. But
Hey, someone has to be, right?
We can't all be alphas.
Yeah, hey, listen, I like to wake up. I generally am greeted with my coffee, right? Get my morning call with my analyst in the morning, and then, breakfast is served. But, if I had to do it all myself, I'd be up at 3 too. Well, no, Christian, thank you so much for your time. Thank you for all those listening in. If you have any questions, want to connect or be a guest on our podcast, please reach out to us at info@telehelping.com. If you enjoyed and liked this today, please subscribe and follow. And again, thank you for tuning in today. Take care, Christian.
Thank you. You too.
This video was brought to you by our official sponsor, Telehelping. Need support for your business? Telehelping connects you with top-tier remote staff to help you streamline operations and fuel growth. Go to telehelping.com and get started today.